Have you noticed something unusual in the silver market? Despite higher interest rates, persistent inflation concerns, and growing uncertainty over Federal Reserve policy, silver has refused to collapse. In fact, every meaningful dip continues attracting buyers, even while many analysts expected precious metals to remain under heavy pressure. So, what is the market seeing that many investors are missing? Is silver quietly preparing for its next major breakout, or is this simply another temporary rebound before prices move lower again? The answer isn't hidden in today's price chart. It lies inside the relationship between the US dollar, Federal Reserve policy, global inflation, geopolitical tensions, and one of the biggest industrial investment booms in modern history. By the end of this analysis, you'll understand why professional investors are watching silver more closely than they have in months, and why the next few weeks could determine the direction of the entire precious metals market. Let's begin with the latest market picture. Silver entered the final trading session of the week trading near the $59 per ounce level, according to the market reports available at the time of this analysis. Although prices eased slightly during the session, the metal remained close to recent highs after recording gains over the previous two trading days. More importantly, silver appeared ready to finish the month with a modest gain, recovering part of the sharp decline experienced earlier. This recovery immediately caught the attention of institutional investors because it suggested that buyers were becoming more confident whenever prices moved lower. One of the biggest reasons behind this resilience was the sudden weakness in the US dollar. The dollar experienced a sharp decline after markets reassessed expectations for future Federal Reserve policy. Reports also suggested that Japanese authorities may have intervened in currency markets to support the yen, adding additional pressure on the greenback. Whether intervention ultimately proves significant or not, the immediate result was a weaker dollar. For silver, this matters enormously. Like gold, silver is priced internationally in US dollars. When the dollar weakens, precious metals become relatively cheaper for buyers using other currencies. That often encourages additional global demand and provides short-term support for prices. However, currency movements tell only part of the story. The Federal Reserve also delivered one of the week's most closely watched decisions by leaving interest rates unchanged. On the surface, this looked supportive for precious metals because the Fed chose not to tighten monetary policy further, but investors quickly realized that policymakers were not declaring victory over inflation. Instead, Federal Reserve officials continued emphasizing their commitment to restoring price stability. They made it clear that future policy decisions would depend entirely on incoming economic data rather than following a predetermined path. That distinction is extremely important. Keeping rates unchanged does not necessarily mean interest rate increases are finished. It simply means the central bank wants more evidence before making its next move. Financial markets responded by continuing to price in the possibility of another rate increase later in the year. Those expectations helped prevent an even stronger rally in precious metals because higher interest rates generally increase the attractiveness of interest-bearing investments compared with non-yielding assets like gold and silver. This explains why silver has remained remarkably balanced. Bullish investors point to the weaker dollar, resilient physical demand, and growing geopolitical uncertainty. Bearish investors focus on elevated treasury yields, restrictive monetary policy, and the possibility that inflation could remain above the Federal Reserve's target for longer than expected. Neither side has fully taken control. Instead, silver has entered a consolidation phase, where every decline attracts long-term buyers, while every rally encourages short-term profit-taking. Professional investors often view this type of market behavior as healthy rather than bearish. Strong bull markets rarely move in straight lines. They pause, consolidate, shake out weak hands, and build stronger support before attempting the next major advance. Another important reason investors continue monitoring silver is that its investment story differs significantly from gold. Gold is primarily viewed as a monetary asset and a traditional safe haven. Silver, however, carries a dual identity. It benefits from safe haven demand during periods of financial uncertainty, but it is also a critical industrial metal used in solar panels, advanced electronics, electric vehicles, semiconductors, artificial intelligence infrastructure, and modern electrical systems. This means silver does not depend solely on investor sentiment. It also benefits from long-term structural demand created by technological innovation and industrial expansion. As governments and private companies continue investing billions of dollars into renewable energy, AI data centers, and digital infrastructure, silver remains one of the most strategically important industrial metals in the global economy. That long-term demand provides an additional layer of support that many short-term traders often overlook. At the same time, geopolitical developments continue adding uncertainty to financial markets. Renewed tensions in the Middle East have increased concerns about energy supplies, global shipping routes, and future inflation. Rising oil prices could eventually feed into transportation costs, manufacturing expenses, and consumer prices, making the Federal Reserve's job even more difficult. And this is where silver's story becomes far more interesting than many investors realize. Because while everyone is focused on whether the Fed will raise rates again, a much bigger macroeconomic battle is quietly unfolding beneath the surface, one that could influence not only silver, but also gold, the US dollar, bond yields, and the global economy over the coming months. That is exactly where we'll continue in part 2, as we break down why the Federal Reserve's so-called hawkish hold may actually be laying the foundation for the next major move in silver, and why the market could be underestimating the importance of inflation, oil prices, and institutional positioning. If interest rates are shaping silver's short-term direction, then geopolitics may determine its long-term momentum. Throughout history, every major geopolitical crisis has forced investors to rethink where they store wealth and how they manage risk. Sometimes those events create only temporary market volatility. Other times, they reshape the global economy for years. The question today is whether the current tensions in the Middle East represent another short-lived headline or the beginning of a longer period of economic uncertainty. Recent military developments between the United States and Iran have once again placed the region at the center of global financial markets. While the immediate focus remains on security and diplomacy, professional investors are asking a different question. What happens if these tensions begin affecting global energy supplies? That question matters because energy is the foundation of every modern economy. Oil powers transportation. Natural gas supports electricity generation and manufacturing. Shipping routes connect global supply chains. If any of these systems experience significant disruption, the impact quickly spreads far beyond the Middle East. One of the world's most strategically important maritime regions remains the Strait of Hormuz. A large share of globally traded crude oil and liquefied natural gas passes through this narrow waterway. Even when shipments continue without interruption, rising military tensions often increase insurance costs, shipping expenses, and market uncertainty. Traders don't wait for a complete disruption, they react to the possibility of one. This is exactly why oil prices often move before the broader economy does. Higher oil prices affect businesses almost immediately. Manufacturers pay more to operate factories, airlines face higher fuel expenses, shipping companies absorb higher transportation costs, agricultural producers spend more on fuel and fertilizers. Eventually, retailers pass part of those higher costs on to consumers. This chain reaction transforms an energy shock into broader inflationary pressure. And inflation brings us right back to the Federal Reserve. For months, the central bank has been trying to bring inflation closer to its long-term target. Progress has been encouraging, but policymakers have repeatedly stated that they need sustained evidence before declaring victory. If energy prices begin climbing because of geopolitical events, inflation could remain elevated for longer than markets currently expect. That possibility creates a complicated environment for silver. On one side, persistent inflation can increase demand for precious metals as investors look for assets capable of protecting purchasing power. On the other side, higher inflation may encourage the Federal Reserve to maintain restrictive monetary policy, supporting Treasury yields and the US dollar, two factors that often create short-term pressure on silver. This is why the market has become so sensitive to every geopolitical headline. Investors are no longer reacting only to military developments. They are trying to estimate how those events will influence inflation, interest rates, and economic growth over the coming months. Another important factor often overlooked is investor psychology. Financial markets do not always wait for economic damage before adjusting prices. Sometimes, uncertainty itself becomes enough to trigger defensive positioning. Large institutional investors regularly rebalance portfolios when geopolitical risks increase. Rather than attempting to predict every headline, they gradually increase exposure to assets that have historically performed well during periods of uncertainty. Gold has traditionally been the first choice. Silver often follows, but with a unique advantage. Unlike gold, silver benefits from both investment demand and industrial demand. This dual role makes silver one of the most fascinating assets in the commodity market. Even while geopolitical uncertainty encourages safe haven buying, another powerful trend continues supporting industrial consumption. Artificial intelligence. Over the past 2 years, governments and technology companies have invested hundreds of billions of dollars into AI infrastructure. New data centers, semiconductor manufacturing facilities, advanced networking equipment, and high-capacity electrical systems all require silver because of its unmatched electrical conductivity. The clean energy transition adds another structural source of demand. Solar panels remain one of the fastest-growing applications for silver worldwide. As countries continue expanding renewable energy capacity, industrial demand for silver continues growing alongside investment demand. This combination is unusual. Few commodities benefit simultaneously from technological innovation, renewable energy expansion, monetary investment, and safe haven buying. That is one reason many long-term analysts remain optimistic about silver despite its recent volatility. However, optimism should never replace discipline. Markets rarely move in straight lines. Periods of consolidation often test investor patience before major trends develop. Professional investors understand this. Instead of reacting emotionally to every price swing, they focus on whether the long-term investment thesis has changed. At the moment, the evidence suggests it has not. Industrial demand remains supported by structural global trends. Investment demand remains supported by macroeconomic uncertainty. Central bank policy remains data-dependent. Geopolitical tensions remain unresolved. These factors together create a market that is building pressure rather than releasing it. Now let's look at what institutional traders are watching most closely. They are not asking whether silver can rise by $1 or $2. They are asking whether the current consolidation is building the foundation for the next major cycle. To answer that question, technical analysis becomes just as important as macroeconomics. Support levels reveal where long-term buyers continue entering the market. Resistance levels reveal where short-term traders are taking profits. Volume shows whether institutional money is quietly accumulating positions or reducing exposure. When all three begin moving in the same direction, the probability of a sustained trend increases dramatically. At the moment, silver appears to be approaching exactly that type of decision point. The market is no longer driven by one headline or one economic report. It is being shaped by the interaction of monetary policy, geopolitical uncertainty, industrial demand, and investor expectations. Sooner or later, one of these forces will become dominant. And when it does, silver's next move could be significantly larger than many investors currently expect, where we'll combine technical analysis, institutional positioning, Federal Reserve expectations, and long-term macro trends to identify the most likely scenarios for silver and explain what investors should watch before making their next move. As we move deeper into this analysis, one thing becomes increasingly clear. The silver market is no longer trading purely on today's news. Instead, it is trying to price in what the global economy will look like 6 to 12 months from now. That is why every move in silver now reflects a combination of expectations rather than current conditions. Investors are no longer asking where inflation stands today. They are asking where inflation will be by the end of the year. They are no longer reacting only to the Federal Reserve's latest decision. They are trying to anticipate its next one. This forward-looking behavior explains why silver has continued consolidating instead of making an explosive move in either direction. From a technical perspective, the market is approaching one of its most important decision points in months. Recent price action suggests that silver has successfully defended its major support zone after recovering from the sharp correction seen earlier. Every attempt by sellers to push prices significantly lower has attracted fresh buying interest. At the same time, every rally toward higher resistance levels has encouraged profit-taking from short-term traders. This balance between buyers and sellers has created a classic consolidation pattern. Professional traders understand that consolidation is not necessarily a sign of weakness. Very often, it represents a period where institutional investors quietly build positions while waiting for a major catalyst. History has shown that some of the strongest rallies begin only after weeks or even months of sideways movement. During these periods, impatient traders often exit the market, while long-term investors gradually accumulate positions without attracting widespread attention. This may be exactly what is happening now. Several respected market analysts have noted that silver's broader technical structure remains constructive despite recent volatility. The previous breakout attempt has not been invalidated, but neither has it received the strong follow-through needed to confirm the beginning of a sustained bull market. In simple terms, the market has opened the door for higher prices, but it has not yet walked through it. One reason is seasonal trading activity. Historically, the summer months often experience lower trading volumes as many institutional participants reduce activity during the holiday period. Lower volume generally means fewer large institutional orders capable of driving strong directional trends. This helps explain why both gold and silver have recently struggled to maintain momentum after short-term rallies. However, seasonal weakness should not be confused with long-term weakness. As trading activity returns after the summer, market liquidity typically increases. If incoming economic data supports the existing bullish narrative, stronger participation from institutional investors could provide the momentum that has so far been missing. Another critical factor investors should monitor is the relationship between silver and the US dollar. Over the past several years, this inverse relationship has remained one of the strongest drivers of precious metals. When the dollar strengthens because of higher interest rates or stronger economic data, silver often experiences temporary selling pressure. When the dollar weakens because markets begin expecting easier monetary policy or slower economic growth, silver usually benefits from increased international demand. This relationship does not operate perfectly every day, but over longer periods, it remains one of the most reliable macroeconomic indicators affecting precious metals. The bond market deserves equal attention. Treasury yields continue reflecting changing expectations regarding inflation and Federal Reserve policy. If yields remain elevated because investors expect tighter monetary policy, silver may continue facing resistance despite strong industrial demand. If yields begin moving lower as inflation moderates and economic growth slows, precious metals could receive an important additional tailwind. Now let's consider institutional positioning. Large asset managers rarely buy aggressively after major rallies. Instead, they typically increase exposure during periods of uncertainty and consolidation when valuations appear more attractive. Current price behavior suggests that many institutional investors are maintaining exposure rather than abandoning the precious metals sector altogether. This is supported by the resilience both gold and silver have demonstrated despite facing multiple headwinds simultaneously: higher interest rates, persistent inflation concerns, geopolitical instability, a relatively resilient U.S. economy, and continued uncertainty regarding Federal Reserve policy. The fact that silver continues holding above key support despite all these challenges suggests that long-term confidence has not disappeared. Instead, investors appear to be waiting for greater clarity. So what could become the catalyst that finally breaks this equilibrium? There are several possibilities. A weaker than expected inflation report could strengthen expectations that the Federal Reserve has finished tightening monetary policy. A significant slowdown in employment or consumer spending could reduce Treasury yields and weaken the dollar. An escalation in geopolitical tensions could increase safe haven demand across precious metals. Or stronger industrial data, particularly from sectors such as artificial intelligence, renewable energy, and advanced manufacturing, could reinforce confidence in silver's long-term demand outlook. Any one of these developments could become the trigger that shifts market sentiment. But perhaps the most important lesson for investors is this: successful investing is rarely about predicting the exact day a breakout begins. It is about recognizing when the long-term fundamentals remain intact, while short-term uncertainty creates opportunity. At the moment, silver appears to be sitting exactly in that type of environment. The market has not yet confirmed its next major trend, but it has also refused to break down despite facing considerable macroeconomic pressure. That resilience should not be ignored, because markets that refuse to fall on negative news often deserve even closer attention than markets that rise on positive headlines. Now we arrive at the most important part of this entire analysis. In Part 5, we'll build our independent macro outlook and answer the question every silver investor is asking. Is silver preparing for a historic breakout in the months ahead, or will Federal Reserve policy and a stronger US dollar keep prices trapped inside this consolidation for longer? We'll also discuss what this means for gold, the broader commodity market, and how long-term investors can position themselves without relying on speculation or emotion. As we reach the end of this analysis, let's return to the question we asked at the very beginning. Why has silver remained so resilient despite higher interest rates, Federal Reserve uncertainty, and growing geopolitical risks? After connecting all the macroeconomic pieces together, the answer becomes much clearer. The silver market is currently being supported by two powerful long-term forces. The first is its traditional role as a precious metal. The second is its rapidly growing importance as an industrial metal. These two drivers are working together in ways we have rarely seen before. On one side, investors continue buying silver as a hedge against inflation uncertainty, geopolitical tensions, currency volatility, and expanding government debt. Every time global financial markets become more uncertain, precious metals regain attention because they have historically preserved value during periods of economic stress. On the other side, industrial demand continues expanding. The global transition toward artificial intelligence, renewable energy, electric vehicles, advanced electronics, and high-performance computing is creating structural demand for silver that simply did not exist at today's scale a decade ago. Every new AI data center requires advanced electrical systems. Every semiconductor manufacturing facility depends on precision electronics. Every solar project increases industrial silver consumption. Every electric vehicle contains significantly more silver than many conventional technologies. These are not short-term trends. They represent long-term structural changes in the global economy. This is one of the strongest arguments supporting silver over the coming years. However, successful investing requires balance. While the long-term outlook remains constructive, investors should never underestimate short-term risks. The Federal Reserve remains one of the biggest variables. If inflation stays above target or begins rising again because of higher energy prices, policymakers may decide to maintain restrictive monetary policy for longer than markets currently expect. Higher interest rates generally support Treasury yields. Higher Treasury yields often strengthen the US dollar, and a stronger dollar usually creates temporary pressure on precious metals. This explains why silver has not yet produced the explosive breakout many investors expected. But there is another scenario. If inflation continues easing while economic growth gradually slows, the Federal Reserve may eventually gain enough confidence to maintain a prolonged pause or consider future policy easing. That environment has historically been much more supportive for both gold and silver. A softer dollar combined with lower bond yields would reduce one of the biggest headwinds facing precious metals today. Now let's examine the broader global picture. Central banks around the world continue navigating an environment of elevated debt, geopolitical uncertainty, and slower long-term economic growth. Governments continue borrowing heavily. Fiscal deficits remain large in many advanced economies. Global supply chains are still adjusting after years of disruption. Energy security has become a strategic priority. These structural developments continue supporting the long-term investment case for real assets, including precious metals. This does not mean prices will rise every week or every month. Markets move in cycles, corrections are normal, consolidation is healthy. Periods of uncertainty often create the strongest opportunities for disciplined investors who focus on long-term fundamentals instead of daily headlines. This brings us to one of the most important lessons in macro investing. Do not confuse volatility with weakness. Silver has experienced significant price swings throughout its history, yet every major long-term bull market has included periods where investors questioned whether the rally was over. The strongest trends often begin when market confidence is at its lowest. That is why patience remains one of the most valuable assets an investor can possess. Instead of asking whether silver will move tomorrow, experienced investors ask whether the fundamental investment thesis remains intact. Today, the answer appears to be yes. Industrial demand remains strong. Safe haven demand remains relevant. Global technological investment continues expanding. Geopolitical uncertainty has not disappeared. The Federal Reserve remains data-dependent rather than aggressively tightening. None of these factors guarantees higher prices, but together they create a foundation that continues supporting silver over the medium and long term. So what is my independent macro outlook? Based on the currently available verified information, I believe silver is moving through a consolidation phase rather than entering a long-term bear market. The market is absorbing the impact of higher interest rates while gradually building support from industrial demand and investor positioning. If inflation continues moderating and the Federal Reserve eventually adopts a less restrictive stance, silver could have the potential to outperform many traditional asset classes. If inflation unexpectedly accelerates because of energy prices or geopolitical developments, short-term volatility may increase. However, even in that scenario, silver's dual role as both an industrial and monetary metal could continue attracting long-term investors. The key is not predicting every price movement. The key is understanding the macroeconomic forces driving the market, because when you understand the bigger picture, temporary market noise becomes much less important. As an independent macro analyst, my approach remains unchanged. I do not follow market hype. I do not chase headlines. I follow verified economic data, central bank policy, institutional trends, and long-term structural changes that shape financial markets. That discipline is what separates investing from speculation. If you found today's analysis valuable, don't forget to subscribe to Macro Bullion. Every week, we break down the biggest developments in silver, gold, inflation, Federal Reserve policy, central banks, the US dollar, interest rates, and the global economy using verified data, independent research, and objective macro analysis, so you can make informed decisions instead of emotional ones. Now, I'd like to hear your opinion. Do you believe silver is building the foundation for its next major bull run, or do you think higher interest rates will continue keeping prices under pressure? Share your thoughts in the comments below. And remember one final point. This analysis is based on publicly available information and verified economic data available at the time of recording. Markets can change rapidly and no forecast is guaranteed. This video is for educational purposes only and should not be considered financial advice. Always DYOR, do your own research before making any investment decision. Thank you for watching Macro Bullion. Stay informed, stay disciplined, and I'll see you in the next macro analysis.